Welcome to the Friday Five with Steve Greenfield on CBT News.
Welcome to this week's Friday Five. This is Steve Greenfield from Automotive Ventures, and thanks for joining us. The news cycle continues at a torrid pace this year, and this last week was no exception. It's amazing just how much change is coming to the industry. It seems that if you blink, you may miss big news that potentially impacts the franchise dealer model. This week, I wanted to recap 3 key news items that came across the wire over the past week. News that dealers should particularly be focused on monitoring. First up, there's no sign that physical dealership buy-sell activity is going to slow down anytime soon. Lithia Motors has been the most ravenous of the public acquirers, with a stated goal to get to 500 rooftops and $50 billion in revenue before they've built out their planned footprint. Lithia's aggressive pace of acquisitions has provided a floor for valuations in the market. Just this week, Lithia announced the purchase of 10 dealerships across southern Florida and Nevada, which will add $950 million in expected annualized revenue. The U.S. dealership buy-sell market so far is tracking at a similar pace to a record-breaking 2021, last year being widely considered the biggest year for store acquisitions in history. The number of dealerships that changed hands in Q1 of 2022 was similar to that of Q1 2021. In parallel, valuations continue to bounce along at an all-time high. From my perspective, it's not likely that valuations will get much higher than they are today. And when natural acquirers like Lithia has satisfied their appetite and filled out their planned footprint, it's very likely that valuations will start to regress back towards historical levels. High inflation and fuel prices, low consumer sentiment, rising interest rates, and declines in the stock market may actually speed us more quickly back to more normalized valuations. But for now, these record high valuations are being applied to record high profits, largely attributable to a lack of new inventory supply. Many dealers are taking the opportunity to translate these excess profits into acquiring more physical stores. While the dealer principals I speak with are generally targeting only underperforming stores, where they can justify paying sky-high valuations applied to these inflated profits, I imagine some of the buyers in this current environment will eventually feel buyer's remorse when valuations inevitably fall back down to earth. Next up this week, very interesting news from Ford Motor Company, who announced that they have stopped allowing customers in most states to purchase their electric vehicles at the end of a lease, a policy they say will help manage EV battery recycling. For example, Ford Credit said customers who lease an F-150 Lightning, Mustang Mach-E, or E-Transit must return the vehicle when the contract is up, and then they can renew their lease with a new vehicle if they choose. While Ford is communicating this initiative is to help reclaim the raw inputs into batteries, as prices have skyrocketed over the past year, I think there may be other dynamics at play. I believe this will allow Ford to control residual value risk for new EV models that might have volatile pricing at the end of the term. We're going to see a proliferation of new EV models over the next 18 months, not only from Ford, and the other OEMs are certainly not going to be able to accurately predict residual values on all of these new vehicles. By controlling used car supply, Ford can closely monitor and influence the price of used pricing. Both GM with CarBravo and Ford with Blue Advantage now manage their own online used car websites. By controlling the off-lease volume, they can ensure that unique, attractive used vehicles are only available on their own proprietary sites. The automakers have been observing recent used car dynamics, including the fact that most vehicles are coming back at the end of lease term with thousands of dollars of positive equity. Ford will essentially have a call option to participate economically in any vehicle coming back with positive equity, instead of surrendering that profit to the consumer or to the dealer. It's also likely that Ford realizes that battery and charging technology is going to advance so quickly, they may want the option of removing used EVs from the road that just may not perform competitively versus brand new models being sold in the future. Preventing the consumer from being able to buy the unit at the end of the term does make a lease feel a lot more like a subscription product. If we think about broader implications of this move and anticipating that other OEMs will elect to follow the same path, it will mean far fewer off-lease vehicles available to the automakers' franchise dealer networks and to independent dealerships. We'll be watching to see which other automakers announce similar plans over the coming months. I expect we will see many others follow Ford's lead. Last, but definitely not least this week, the Federal Trade Commission has signaled that increased regulation may be coming to dealer F&I profits. This week, the FTC proposed banning finance and insurance coverage and physical vehicle add-ons that quote-unquote provide no benefit, and requiring expanded disclosure and consent on such optional products, including a list of prices online. The agency is also considering cracking down on dealerships' advertising related to the cost of the vehicle itself. An accompanying press release repeatedly depicted physical additions and F&I products as quote-unquote junk fees, though the four commissioners on the FTC supporting regulations acknowledged in a separate statement that not all add-ons provide no value. The FTC's proposed regulations include bans on all products without benefit, posting a list of all optional add-ons and their prices online, bans on misleading pricing advertising, disclosure and declining in writing of the cash price without optional add-ons, and express informed consent on F&I products and other add-ons. Since the CFPB was largely defanged during the Trump administration, there hasn't been much threat about regulators squeezing dealer finance and insurance profits. We'll be keeping a close eye on this latest development, and if the FTC or any other government agency starts encroaching and threatening dealership profit centers. I told you the news cycle was busy this week. All of these issues should be closely monitored by dealerships and have wide implications for the franchise dealership model and ongoing profitability into the future. So with that, let's transition to our companies to watch. Every week, we highlight interesting companies in the automotive technology space to keep an eye on. If you read my monthly industry intel report, I showcase a few companies each month, and we take the opportunity here on the Friday 5 to share some of those companies each week with you. Today, we have two companies to watch, Wrenchway and Axion. Our first company to watch this week is Wrenchway. For as long as I remember, I have heard from dealerships that they've had a hard time recruiting and retaining technicians. Wrenchway is a job recruitment platform for both technicians and service departments and is changing that dynamic by giving techs an insider's view of dealerships' operations, equipment, pay levels, company culture, and other pertinent information. Wrenchway accomplishes this with its Top Shop program. Dealerships pay $150 per month to be listed as a Top Shop, but the listing is much more in-depth than just a typical job board post. Dealers are required to include specific information before posts are accepted, including pay levels for technicians, workplace amenities offered, think things like air conditioning and heating, and available equipment. In addition, the posting must include videos that show what the shop looks like, as well as interviews with technicians and fixed ops management who talk about what it's like to work in their shops. This unique approach markets the dealership and the opportunity to more than just the job seeker. The reason I love this company is because they are attempting to solve one of the biggest pain points for dealers' fixed ops departments, recruiting and retaining technicians. The company was started because a dealership needed help recruiting, and they wanted to bring technology and process to make their efforts repeatable and scalable. You can check out Wrenchway at www.wrenchway.com. Our second company to watch this week is Axion. Axion is an AI platform and predictive digital offering for engineers and QA management that allows users to very efficiently mine through tons of unstructured data to efficiently derive insights to accelerate vehicle development. Axion's mission is to empower engineering leaders with the best decision intelligence platform to strengthen decisions to deliver the best results. Forward-thinking engineering leaders across automotive, aerospace, and defense leverage Axion to accelerate product development, enhance program planning and collaboration with suppliers, and improve quality using Axion's predictive AI-based digital platform. Customers include Boeing and the US Air Force. The reason that I love this company is that they have the ability to augment a user's current process to very quickly and efficiently mine through tons of unstructured data to derive insights. Axion provides clear visibility into future results of today's decisions and actions. Check out Axion at www.axionray.com. So that's your weekly Friday 5. If you're an auto tech entrepreneur working on a solution that helps car dealerships, we want to hear from you. We are actively investing out of our new dealer fund. If you're a dealer who wants to invest in early stage auto tech companies that benefit your business, let me know. We are still accepting new investors into this new fund. Thank you for tuning in to CBT News for this week's Friday 5, and we'll see you next week.
Thanks for joining us for another edition of the Friday 5.